Yo, what's up guys, it's T.Mayne back again. Super awesome to have you guys here. As you know, we're gonna be getting into some trading concepts, some technical analysis. This is what the channel is about. But for today's video guys, we're gonna be breaking down these accumulation and distribution phases. Now I've simplified this process so easy for you guys that we're not even gonna get caught up in the words and the terminology, but I've broken it down into a way that you can understand, into something that you can use as a subjective trader, into something that you can use and something that you can understand to actually make profits, to actually profit from something, to actually learn this concept. Guys, I've broken it down. Hop onto the charts with me and let's get started. Thanks for hopping onto the charts with me guys. So as we spoke about, we're gonna go through the accumulation and distribution phases. Now guys, we first need to break down what accumulation and distribution phases are. I know I kind of went over it in the previous video, but for the purpose and just so that this video can flow, let's go over that one more time. Now what an accumulation is a market that is basically accumulating positions for a move to the upside. So an accumulation is just a consolidation that leads to a breakout in prices to the upside, which we call a mark up. And a distribution is the opposite. A distribution is when the market enters some sort of a consolidation phase in preparation for a move down, which we call a mark down. That's all accumulation and distribution are. Now how I use this, because most of my trading is based off chart patterns. Now chart patterns obviously involve continuation structures, reversal structures, and the like. Now I only involve myself in the market trading these corrective structures. Corrective structures can be structures like continuation structures, they can be structures like reversal structures. When we break down those structures, we eventually see those structures as either an accumulation or a distribution for the next potential move. So that's how I incorporate this idea of accumulation and distribution with my normal chart patterns. Now, as I told you guys, we're gonna go into one line and two line accumulation and distribution phases. Now, the type 1 of a one line accumulation phase, the reason why we're calling this one line accumulation phase is because we have one support area that has been established, or one low in the market that has been established, that we are expecting to be violated to the downside before prices actually make that mark up. Now the first type of accumulation, the simplest way I can convey this information is to think about it like this. We have a market that comes down, creates a double bottom structure and violates that double bottom structure, and then we see a mark up. So the first type guys, our double bottom structure, this is for an accumulation. Remember, an accumulation is for higher price action. Obviously a distribution of this type would be the opposite, where we see prices creating that double top structure, kind of breaking the neckline and then violating that double top structure before we actually see the mark down. Now guys, let's think about why we would call this a one line accumulation. Now let's imagine we have an impulsive market that is pushing to the upside, that enters something that a normal trader would call a flag. Now we need to have an objective rule as to what this flag is. How do we define this flag? How do we not say that this flag is a rectangle, a continuation like some type of a rectangle? Now, the objective way is that we want to see a low being established. Once this low has been established, we want to see a violation of this low followed by higher prices. Now, how do we trade? We always want to get in on the higher prices. What I'm looking to trade by looking at these accumulations and distributions is I'm looking to trade off these manipulations. That's what I'm doing. After we see this manipulation that violates one structural low, then we expect higher prices. What do we expect after this push? We expect a corrective structure or a pullback for us to be able to jump in on the long-term buy. So this is a form of confirmation waiting for higher prices. So the type 1, we have the double bottom first, and then the violation, and then the markup. Now the type 2 setup that we will look at is sort of similar. So we create that low, We first create that low, then we have our equal lows or our double bottom before or higher than this previous low. What we want to see after we see our low being established, equal lows, we want to see a violation of both these equal lows and the low that was initially established. Once we see this, then we know we can look for those markups. Now, type 3 would be sort of similar as well. So what we have is a market that first establishes this low, then gives us our double bottom structure, and then violates our double bottom structure. So remember, type 1, we have the double bottom first, violation of that double bottom, then the markup. Type 2, we have our low, our double bottom in the middle, and then a violation of structure. And then type 3, we have our low, our double bottom after our low, and then the violation of structure before we have this mark up. Now remember, the reason why we're calling this a one line accumulation, or obviously in the inverse, if we had, for example, a type 3 distribution, I just didn't want to draw both the accumulation and the distribution because the explanation would be exactly the same, just inverted. If we were looking at a type 3 distribution, what would we need? The high, we want the double top structure, and then we want to see a violation of that double top structure and the low, and then the mark down. So that's how we would obviously invert our rules and accommodate for a distribution. Now, where would we normally trade these accumulations, these one line accumulations? We would trade these one line accumulations during the markup phase, or after we've seen those manipulations below the initial low. What are we looking for? We know that in an aggressive trending market, in a market that is trending aggressively, we don't see a lot of, I guess, those deeper corrective structures that we normally expect to see. And how we jump onto those impulsive phases is we look for these one line accumulations, because the markets need to still accumulate. The accumulation will be very fast. We'll just see that low being established, that low being violated, and then we see the markup. Now, a trader that identifies patterns and whatever not will look at this as a bullish flag. Now, if we the reason why we're actually going into this is to kind of go into the reason why a bullish flag would form. What is a bullish flag? Using the concepts of accumulation and distribution. The same thing would be true for a bearish flag. We'd see that high being created, and then that high being violated before we actually see the mark down. Exact same thing. And we'd call this a bearish flag, but I would look at this as a one line distribution. Now, what is a two-line accumulation or a two-line distribution? Just because we have accumulations drawn here, I will show you guys what a two-line distribution looks like. So let's just delete this, we need some space. Now let's imagine for 1 second that this manipulation does not actually follow through for higher price action, but continues to break down. What is that? That would be considered a a two-line accumulation. Now, how many times have we seen the example where, let's just put this line over here, where we've seen markets do something like this? They establish a low, violate that low, establish a new low, violate that low one more time, and then we see the mark up. A normal trader would identify this as some type of a deceleration or a descending structure or a falling wedge or whatever the case is. But remember, because we want to talk about the concepts of accumulations and distributions, we are actually breaking down why descending structures form. Descending structures form because there is distributions or accumulations, regardless, just depending on where the market is coming in from. There are accumulations. Let's just talk about what we have on our chart. We've got an accumulation. So there are accumulations happening, and that's why we see this descending structure. What follows this descending structure is a mark up. During this markup, what do we want to be looking for? We want to be looking for those one line reaccumulations for entry. We want to be looking to jump in on those bearish flags. We've already defined our our bullish flags. We've already defined our bullish flags by creating objective rules as to we want to see a, for example, let's just draw this bullish flag. We want to see a low being established, whether that low has our double bottom structure here, whether that low has our double bottom structure here, whether that low has our double bottom structure at the end. Regardless of that, we want to see our lows being established. After our lows are established, we already know that this is an aggressive trend. We also have other added confluence of our impulse, our corrective structure, whatever the case is. We can throw thousands of different confluences on this, but for today we're talking about these one line accumulations or two line accumulations. Now we want to see our lows being established, and then all we're waiting to see is our low being violated to the downside, prices breaking back within structure. Then what are we looking for? We're looking to enter this trade. We'll obviously find our candlestick confirmations. Maybe we'll find a reversal structure on the smaller time frames at this manipulation. Regardless of whatever, we're looking to jump in on this bullish momentum. We then set our entry, or set we then set our entry, a long position over there. Obviously stops below this, targeting future high areas. But where are we in our longer term structure? In our longer term structure, we've just started our accumulation. We're getting in early enough to still make money, but after the manipulations have actually happened. If we look at where we're getting in, we've waited for all the necessary confirmations that we need. We've waited to see this market accumulate. We've waited to see this market make those moves to the upside. We've waited to see this market give us that continuation structure to actually enter into the position. All of this just using one idea. Just one idea of accumulation and distribution phases. We know that obviously a one line setup, we'd find these when the market is aggressively reaccumulating. So when we're in a strong trend, if we're in a weak trend or the market is actually decelerating to the downside, we'll find a two line reaccumulation or redistribution or whatever the case is. But we'll see our lows being established, those lows being violated, and on the higher lows, that's where we look to get in. We'll even isolate these higher lows on a smaller time frame to then again look for a one line reaccumulation to jump in at the best possible trading opportunity for a trade in the direction of the momentum with the best risk to reward ratio and with the appropriate buying probabilities. Now, guys, I hope you actually enjoyed this video. I hope you got a lot from this video. We went through basically accumulation. We discussed accumulation and distribution phases. We discussed our one line accumulation phases, our one line distribution phases, our two line accumulation phases, and our two line distribution phases. And we've basically discussed how we can actually use these to actually enter into the market, where we should be looking to enter, what actually is happening during these one line and two line accumulation and distribution phases, and how we can actually use this to capitalize. We also spoke about how we can refine our entries and also allow ourselves to enter when the appropriate probability presents itself, and after all of the manipulations, we avoid entering prematurely and getting stopped out on our position by waiting for these objective rules to play out. Now guys, I hope you enjoyed it. I hope you actually took notes to actually, I guess, use this within your own trading. Definitely do give this some thought and re-watch this video if you absolutely need to. If stuff was confusing, maybe just go back, brush up, re-watch the video, and stuff will be a lot clearer the second time around. Now guys, before we go, I actually want to give you guys one more absolutely important tip, and that's you have to have a directional bias before you even decide on using or identifying any accumulation or distribution phases. You need a directional bias first to allow you to find a direction to trade. As usual guys, absolutely appreciate you guys for watching until the end. I hope that you did receive some value. Guys, you know what it is. If you have received some value from this video, definitely drop this video a like. Let me know, let YouTube know that this video is spreading genuine content. Otherwise, if you're not part of the fam, definitely do hit the subscribe button so that you can stay up to date with all the new content that this channel produces. And as well, guys, you know, we're trying to get to 1K subscribers so that YouTube can allow us to actually start live streaming, guys, because I would love to create these videos in person with you guys and actually have that in-person interaction. We need to get to 1K to be able to do that, guys. So help me help you. Subscribe to the channel. Otherwise, this is T.Mayne. Thank you for watching. I'll see you guys in the future videos.